those of you who have a paper copy of the presentation will notice that you'll understand the reason for the delay in a moment, because the presentation that you're about to see is slightly different from the one that's on the paper. And if you look through the paper, you might think, boy, this guy's pretty pessimistic. And that's because you're looking at some of last year's presentation. So I failed to update the first couple of slides. So was anybody here last year? So some of you heard me give a talk similar to this. There's some different material here, but it's going to have quite a different tone this year. Last year I was feeling pretty glum, which goes to show that you shouldn't be too predictive about what's going to happen, because the following year turned out to be a pretty good year for the housing market. So we'll see just how good in just a moment. Everything I say will be my own views and not those of the Federal Reserve Bank of New York or the Federal Reserve System, although I heard Tom wisely quoting Bernanke practically, so that's a good strategy. If you have any hard questions, I'll try to lean on Ben. Okay, so what I'm going to talk about is the housing market. And in particular, we had this historic house price cycle during the 2000s, where we had this enormous run-up in prices and an enormous decline in prices. And that's had very, very important implications for all elements of the US economy. So an important thing to talk about is how that happened. So I'll first document what happened, and then talk a little bit about at least a couple of reasons why we think this might have happened during the 2000s. And then, very importantly, I want to talk about where we are now. So we've had this big cycle. Are we near the beginning of a new period of growth in the housing market, or are we going to expect to see continued decline? You'll see there's some reason for optimism, but also a little bit of reason for caution. So I'll talk about that. And as we look forward, we want to think about what kinds of things are influencing the direction of the housing market. So mortgages are obviously very important, and while things have improved, there's still a reason to think that we might need some additional effort on the housing front. So we'll talk about the modification program and where it stands. That's an important element of the administration's and the public program for housing in the United States, and then I'll conclude. Okay, so let's talk about the 2000s housing cycle. The top panel here on the left shows the CoreLogic house price indexes for the period from 2000 to the end of 2012. And what we see are two different lines. One is the overall index, which includes all the transactions for which CoreLogic has repeat sales. And then the green line is excluding distressed sales. So typically, during this cycle, distressed sales have been foreclosures. There's some other reasons for distressed sales, the death of the homeowner or something like that. But typically, the great majority of these distressed sales have been foreclosure sales, sales out of banks' inventories, or sales from a homeowner who's underwater and behind on the mortgage. And you can see that both of those price indices rose very, very sharply in the first half of the 2000s. That's not going to be a surprise to anyone. The second thing that won't be too surprising is that they came down very sharply, especially the index that includes these distressed sales. So as is probably no surprise to anyone in the room, foreclosure sales take place at a discount. And you can see that by the difference between the red line and the green line coming down. So as the housing market began to fall apart, prices for distressed properties, distressed sales, foreclosure properties, came down much faster even than prices for other kinds of properties. But it's noticeable that the green line came down quite a lot too, about a third from its peak to the trough. Now, importantly, since last year, prices have really increased, and we'll talk a little bit about how much they've increased in a minute. But regardless of the index, these prices have increased over the last 12 months. Okay. In the bottom panel, you can see the distressed sales share. So this is the share of all sales measured in the CoreLogic's repeat sale index, which is a very broad index that covers all kinds of housing transactions. The share that is coming from these distressed sales. And you can see that that thing historically, is there a pointer here? Well, look to the left of the chart on the bottom, and you'll see that that thing historically between 2000 and 2004 hovered around 5%. So 5% of all sales were these distressed sales. And that share skyrocketed during the crisis, all the way up to about 40% at its peak. And it's hovered around 30 to 40% for the last couple of years, and right now it sits around 33%. So roughly a third of all transactions in the housing market are still distressed sales. So that's kind of distressing. Okay. So if you think that was a big cycle, you haven't seen anything because you haven't seen Las Vegas yet. So Las Vegas had a cycle that was even more substantial than the rest of the country. So from 2000 to 2007, prices roughly tripled in Las Vegas. I'm sorry, doubled in Las Vegas and roughly tripled in Miami. Prices have come back down in both of these markets. In Las Vegas, prices actually came down. It's a little hard to see on the chart, but you can see that prices came down actually below 1 on this index. So the chart is indexed to 1 in 2000. So by 2012, the middle of 2012, prices had come down below 1, which means that they were nominally lower than they had been in 2000, 13 years before, 12 years before. So that's obviously a huge tumble from their peak. In Miami, we saw a very large run up again, but prices didn't come down nearly as far. And in fact, even now, there's something like 70 to 80% above their 2000 levels. So there's still noticeable price appreciation over the last 12 years in Miami. Not so much real price appreciation, but certainly some substantial nominal appreciation. These big increases and then sudden busts in the house prices is pretty good evidence that we went through a speculative bubble. And we went through a speculative bubble in what is the most important asset owned by the great majority of US households. It's the most important asset on the balance sheet of the household sector. And because of that, we had an enormous decline in housing equity and the wealth of the US households. So the green line here shows owner's equity as a percent of real estate value. And that's measured on the right scale. And you can see that that thing, during the period leading up to the crisis for the first half of the 2000s, was hovering around 58% or something like that, just above 50%, this green line. And then during the crisis, as prices came down, the red line came down sharply. The value of real estate fell sharply, and so did owners' equity in housing markets. Now, one thing that's interesting to look at is the blue line. So the blue line shows mortgage balances. So during the period when house prices were rising really sharply, when the red line was going up quickly, households were actually taking out mortgage debt basically in such a way as to keep their equity flat. So the green line is amazingly flat given that increase in house prices. How were they doing it? They were increasing mortgage debt at the same time that house prices were going up. So they're essentially using mortgages to keep their equity share roughly constant. Now, it's hard to know exactly how to think about that. Were households actually targeting that level of housing equity, or were they just simply reacting to prices? And they say, well, our house price looks like it's up about 10%. Maybe we can take out 10% more in our HELOC, using rules of thumb like that. Whatever the reason, it did end up with this relatively constant level of home equity percentage, this green line. Now, since the peak in 2008, house prices have come down, as we've noted before, and then sort of flattened and maybe come up a little bit. And mortgage debt has come down as well. But of course, households deleveraging, trying to unwind these mortgages that they've taken on, takes a lot longer than it does to borrow. So anybody who's borrowed money and then tried to pay it off realizes it's a lot easier to get the loan than it is to pay it back. And so there's evidence of that here. The blue line comes down much more slowly than the red line, and so owner's equity share falls quite sharply. Now, in recent quarters, that thing has gone up. Again, with the increase in house prices, we've seen a little bit of a revival here in some of these important measures. Now, this is, again, we're talking about trillions of dollars here. The red line shows the value of household real estate in trillions, so it goes from like 22 down to 16 trillion or something like that. So that's a huge loss in wealth, $6 trillion lost in a very short period of time. Okay, so one of the implications for all this is for homeownership. And in the top panel here, we have the homeownership rate for the United States from 1965 through the end of 2012, I think, or maybe even the beginning of 2013. And what's interesting to me in this picture is that for about 30 years, between 1965 and 1995, the homeownership rate hovered around between 63 and 65%. And then, starting in about 1995, or the late 1990s, it started this long increase. And peaked, boy, I wish I had a pointer. I do. Peaked in 2004. Now, 2004 is an interesting date because that's 2 full years before the housing market peaked, actually. So we should think about that. Why is that the case? But it peaked in 2004 and then started coming back down. Now, an interesting question is, where is it going to end up? Well, one way to think about that is to think about the households that are currently in negative equity. So about 20% of mortgages are, roughly speaking, in negative equity. So you might think that those households will have difficulty ever becoming homeowners again, or at least for a long time. Why? Well, they don't have any equity to trade up, so they can't buy a new house very easily because they can't sell and use the proceeds as a down payment on a new house. If they default, then they're going to be shut out of the credit markets. And so they're likely to stay where they are at best, but that's not going to lead to much increase in the homeownership rate, most likely. So homeownership has been coming down quite sharply, and a big question, we don't know the answer, is where is it going to end up? If you think about negative equity homeowners, there's a big variation across the country, and I'll show you a little bit more about this in a little while. But at the worst, the numbers were getting really scary in places like Las Vegas. So the measured homeownership rate, which is shown here in the blue line, tells you what proportion of occupied units have somebody whose name is on a deed living in that house. A more interesting economic way to think about ownership is who has some equity in the house. And if the owner is in negative equity, you might think that they're more like renters in some sense, because they don't actually own anything. They have their name on the deed, but the home is effectively owned by the bank or the lender. And so if you take those people out of the measured home ownership rate, you get down to some really scary numbers. So instead of the 62 or 3% that the Census Bureau would tell you was owner-occupied units in Las Vegas in 2011 or 12, it gets down to in the 20s. Because so many people are underwater in Las Vegas because of that enormous cycle we observed. Okay. So one thing that's interesting to think about is whether that has any effect on anything. Does it matter that there's a large share of underwater homeowners who are effectively like renters in these metropolitan areas? One thing you might think about is whether these folks will have the long-term vision for the community, which is often associated with homeowners. So why does the homeowner vote for the bond issue even if they don't have kids in school? Well, it's because they think their house value will be increased by voting for that bond issue. If you don't have any equity in the house, then that money is essentially going to the bank. So why would you want to pay those taxes to fund that bond? So that's the argument. So it's interesting to think about what effect these variations in ownership, effective ownership, will have. So how do we get in this position, in this mess? Well, one thing that's important to notice is the increase in the importance of subprime mortgages during the first half of the 2000s and up to about 2006. And in addition to that, the changes in the way those mortgages looked over time. So subprime had been around for a while, before 2005 and 6 and the height of the boom. But the mortgages that were being taken out actually changed quite a bit during the course of the boom. And in particular, if you look at 2006 originations, you can see what the loan-to-value ratios are. So this is like 1 minus these, or 100 minus these numbers is what the borrower was putting down as a down payment. And you can see that even at the median, the 50th percentile subprime mortgage was a 90% LTV, which means they only put down 10%. And for fully fully a quarter of the borrowers, they put nothing down. And this was a part of the market that was very important in 2006. It was about 1/3 of originations were coming out of this part of the market. And these borrowers who put nothing down, with the transactions costs of a realtor and mortgage recording tax, et cetera, you're underwater when you walk out of the closing. So you can't immediately sell your house and pay off your mortgage. So that's a problem. And this is at the peak of the boom. Within 5 years, prices are going to be down 1/3. And so these borrowers are going to be deeply underwater. An additional thing to notice is this DTI, which is the debt-to-income ratio. So what proportion of all the borrowers in each year had a debt-to-income ratio, all debt against their income, of 40% or more? That's a lot, 40% of your income going to debt. In 2002, that number was just about 1/3, but by 2006, it had risen to 50%. So these are people who are using a lot of leverage and committing a lot of their income to paying off debt. And so when the housing market has problems, they're going to be faced with real difficulties. A second thing I'd like to draw your attention to, in addition to just this sort of underwriting in general, is something we've been working on here over the last several months, and that is looking at investors. So it turns out that if you look at the data from something like CoreLogic or one of the usual mortgage data providers, and see what proportion of all borrowers are investors, what you get is the people who checked on the application that they were going to, that this is a property they weren't planning to live in. Anybody who's taken out a mortgage in this room knows that you're asked, are you going to live in the property? And if you check yes, there's a second home, you can check that, or you could say, no, it's an investor property. So very few people actually check investor property. And in fact, somewhat fewer than are in fact investors. So what we have here are looking at the credit records of the people who are originating mortgages in each year and seeing what proportion of them have multiple first liens already. So they already have a bunch of first mortgages, and they're taking out an additional first mortgage. And we can see that the share of people with multiple first liens who are originating mortgages, or the share of mortgages going to people with multiple first liens in 2006 was like 45% in the Sand States. So almost half of all these new mortgage dollars were going to people who had a lot of first liens. 2, 3, 4, 5, 8. We have some with 9 or 10 first liens. You know, flip this house. That's the idea. So there are a lot of investors out there who are actually taking advantage of the subprime market and relatively relaxed underwriting to be able to take out loans and use those to buy investment properties, which speaks to why the homeownership rate peaked so early. 2004, remember, the homeownership rate peaked, but the boom goes on for another 2 years. Why is that? In part, we think it's fueled by these investors. So not much increase in homeownership, just a churning of the market. And that's, again, consistent with some kind of speculative boom going on. The way they did it was to use these non-prime mortgages. So you can, it's a little hard to see here, but the people with multiple first liens on their credit reports were disproportionately using non-prime credit. So they were getting this non-prime credit and using it with very little down to invest in these housing projects. How did they do it? Well, essentially, they didn't tell the truth on the mortgage application. So if you look at the dashed lines here, what they show are the proportion of self-reported investors in the housing market. So that's what they checked on the mortgage application. And then this green line is a proportion of people who actually had multiple first liens and never moved to the zip code that the property is located in. So you can see that this actually is much, much higher. So many researchers have looked at this suspecting that we would find a lot of investor activity. And they've said, no, I guess it's not the investors. Because look, this dashed line is pretty flat. But when you actually look behind the curtain a little bit, you can see that, in fact, multiple first lien holders, if you accept that definition of investors, were much more important than the people who admitted that they were investing. Okay, so those are two things that we think are important to know about in terms of driving the boom. The investor role and also just the underwriting that was taking place in this increasing share of the non-prime market. Oh yeah, the investors, not surprisingly, as soon as prices turn, default in large numbers. So they're the sort of leading the way out the door. Okay. So one question that's really important to think about is, are we there yet? Are we done with this adjustment? Are we finally finished? And I think there's some evidence to think that we might be. So we've now experienced quite a long period of relatively flat house prices after the big decline. And over the last year, we've seen a fairly sizable increase. In fact, you might even consider these somewhat alarming increases. So the US was up 7.4% on the overall index from a year ago to the end of 2012. And Las Vegas was up 15%. Which is, you know, if I lived in Vegas, I'd be like, oh my God, 15% in a year, that's just like, that's boom time rates of increase. So you can see that slope. It's not quite as steep as this, but it's pretty steep. So how do we think about these? And is this in fact alarming? So this is something I think is fun to think about, and I'll look forward to your reaction to it. So I want to talk about the effect of a boom-bust market, boom-bust cycle in the housing sector. And there are two kinds of housing markets that I want to distinguish between. And I'm really following Ed Glazer, Joe Jerko, and Albert Seiss in doing this. So here's the story. So you've got two markets, one of which has completely inelastic supply. So think about San Francisco or maybe New York. So inelastic supply is really hard to build new units in the metropolitan area. A second market has pretty elastic supply. That is, you can add additional units in the metropolitan area. Think Phoenix or Las Vegas, some place where there's like a featureless plane, quote unquote. But of course, both of these markets have a relatively inelastic supply on the downside, because they have this existing stock of housing that's already sitting there. So while they're differentiated by how much how difficult it is to add new units, they're not differentiated very much by how difficult it is to take away units, because units last a long time. So once they're there, they're kind of inelastically supplied. Okay, so that's the important thing. So we have this demand curve, and initially, let's just say there's an equilibrium where we're at point A, and prices are equal to the cost of building new units in both of these markets. Okay, now subprime lending gets going, and investors get interested, and there's a cycle that happens. So now we've got a shift upward in demand. So we've got a bubble forming. Okay, so this shifts the demand upward, and what do we have? We have two different equilibria occurring. In the inelastic market, we don't get any new units, we just get an increase in prices. So we go up to point B, prices go up to P1I, and that's the new equilibrium in that market. In the elastic market, we get less price increase, we just go up to P1E, but we get some new units added. So now we're at H1 in this inelastic market, I'm sorry, elastically supplied market, okay? So two different equilibria based on the same demand shift in these two different kinds of markets. Okay. So now the new demand curve, I'm sorry, the new supply curve for the elastic market. Okay, so I just screwed up everything possible in that sentence. Let me start again. The new supply curve for the elastic market is this one. It's got this inelastic section because we've built all these new units that are sitting there now. Have you been to Las Vegas lately? And then you could add more units if you wanted to, okay? So this is where we are now. And now let's say that the bubble bursts and demand shifts back to where it was before. So now what happens? So now forget about D1, because we're back to D0. So look at the new supply curve. For the elastic market, now prices are going to be falling well below construction cost, because we had this very inelastic supply on the downside. You can't get rid of these units that easily. So a shift back to the original level of demand is going to make prices fall below construction costs, okay? In the inelastic market, things are sort of much more simple. You have this big increase in prices, then they go back to where they were before. That's not very interesting. The more interesting thing is what happens in the elastic market. And so prices return to construction costs in the inelastic market, but they decline below construction costs in the elastic market. Okay. Now, the final thing to notice, so this is the new market. The markets are now on an inelastic supply of the inelastic section of the supply curve, even in the elastic market. So when demand increases even a little bit, it's all going to be reflected in prices. So we're not going to have that many new units put up. Instead, we're going to see pretty big increases in prices almost everywhere after a big boom-bust cycle like the one we've just had. So I've never presented this before in this format, so I'm interested in your reactions to it. But it's interesting and important to think, I think, to think through the price dynamics that we're observing and whether or not they're consistent with sort of what we think is actually happening in the markets that we're observing. Okay, so subsequent demand growth is going to be reflected in price increases, at least until we get back to that original point, and then we'll start to see more units being added in big numbers. Okay, and is there any evidence that something like this is going on? Well, one thing that seems certain is we had a big run-up in excess units over the course of the boom, and then it started to come down after the recession, but as the bust started to unfold, how did it come down? Well, through obsolescence, number one. Number two, some of these units started to get sold slowly but surely. The units are sort of making their way through the foreclosure process and getting onto the market again and getting sold. And you can see that in part because these held off the market numbers, which are the numbers of units that the banks essentially have in their REO inventories but are not offering for sale, still pretty high, but they're not growing at the same pace that they were, especially in the last couple of quarters. They're starting to come down a little bit. It's a little soon to tell, though, so it's a little nerve-wracking that these excess units are still so high compared to earlier in the cycle. Okay. Other signs of some hope are transition rates for mortgage accounts. So this top panel shows transitions from current status of the mortgage to early delinquency. That's the blue line. Is it blue? The top line. And also to serious delinquency. So the serious delinquency rate, transition rate, rose quite sharply during the bust, and then has remained pretty high. There's been a much more pronounced cycle in this transition into early delinquency, which means that we've seen fewer mortgages sort of becoming delinquent than we had earlier in the cycle. And this thing peaked in like mid-2009 and has been coming down erratically ever since. Okay. The green line here is the cure rate. So these are currently delinquent mortgages. And one thing that we've observed is that the ones that are becoming delinquent, early delinquency, are increasingly going back to current. Again, this is a moderate trend since the trough of the cycle, and less commonly becoming 90 days delinquent. So there's always some churn into early delinquency. The question really is what happens to the mortgages once they get into early delinquency. Okay. Here's the foreclosure pipeline. I'll just draw your attention to the pale bars. These are the numbers of the balances of mortgages that are at least 90 days delinquent. This is, again, from our Equifax Consumer Credit Panel data. And you can see that's, again, since the peak in the early 2010, this number has been coming down quite significantly. So there's fewer mortgages that are about to enter foreclosure. These guys, very few of these guys will make it back to current. Most of them will go into foreclosure, but the numbers are coming down. Okay. So I'm going to skim over this pretty quickly. There's a few things that we want to talk about what causes mortgage defaults. In particular, you can think of three important things. One is sort of the debt-to-income ratio. A second is the loan-to-value ratio. So one is the ability to pay the mortgage out of your income. The second is your sort of incentive to pay. Do you have any equity in the property? And then the third is your credit score. Like how much wherewithal do you have when things really get tough? Can you actually make these payments, or do you actually make these payments? So that's what the credit score is intended to measure. So on cash flows, on the debt to income, really the major thing, because interest rates have come down so much, the major thing that's influencing those has been job loss. So even mortgages that are resetting in terms of their interest rates are so low that they're typically lower than even the teaser rates had been. So we're seeing relatively little negative effect of resets, certainly on regular installment mortgages. A bigger source of risk there is the labor market. And this is just one picture of the labor market. I guess Aishigel's already talked to you, so you know much more about the labor market than I do at this point. So I won't belabor this. But an important point is that the discharge rate, which is the blue line here, has come way down from its peak. I'm sorry, from its peak. The discharges are way down, and hires are up a little bit. They're not up as much as you might hope. So there's still some risk coming out of the labor market. The equity margin is a little more concerning. In particular, we still have large proportions and large amounts of negative equity out there. So right now, according to CoreLogic, in the third quarter, about 22% of mortgages were underwater in negative equity, and that's a sort of an at-risk pool of borrowers. If they get hit with a shock, they're going to have a lot of difficulty resolving their mortgage without defaulting. And one thing that's always surprising to people is if you look at a map of the United States, where here the dark red is 30% or more of mortgages in negative equity, and you can see that kind of stuff is spread all over the place. It's not just those 4 sand states. There's little sections of, in Maryland and Virginia, and here, I guess, I can't really see very well, but that looks like Chicago or something, in the Midwest. Anyway, so there's like a more spread out pattern of negative equity and low equity than you might think, given what we hear in the newspaper. Many of those borrowers are deeply underwater. That's what I'll take away from this. These are borrowers that are 125% LTV or more, and that's 12% of all borrowers roughly. They need more house price appreciation than we've seen so far, quite a bit more, to be able to get out of that situation. Negative equity is highly correlated with unemployment. So the places that have high negative equity also tend to have high unemployment shocks, and therefore there's more risk than just the two individually would make you think. Okay, maybe I've got 1 minute left, so let me skip just to the very end. I have a little bit of more material on modifications and what the Home Affordable Mortgage Program, modification program, has been doing over the last year, for those of you who have been here. They've now modified over 1 million mortgages, and about 850,000 of those modifications are still active. The great majority of the modifications, in fact, virtually all the modifications coming out of that program, which is the primary administration program for modifying mortgages, are interest rate reductions. They reduce the interest rate, the coupon rate on the mortgage, down to as low as 2%. to get the borrower's debt-to-income ratio down to 31%. If that's not enough, then they'll start forbearing principal. In other words, they'll say, you don't have to pay interest on this principal until the very end. So we'll put it back to the back of the mortgage, which is essentially another way of reducing interest rates. So there's all this emphasis on reducing interest rates and improving the debt-to-income ratio. Another approach would be to directly modify the principal and reduce principal on the mortgages. So we have some research on that, which you can talk about during the question and answer if you like. One thing that's interesting to note, though, is that during the last few years, about 20% of portfolio modifications reduced principal. So if a bank owns the mortgage, about 20% of the time, when it's a distressed mortgage that they're going to modify, they will reduce the principal. But for government-insured mortgages, Fannie, Freddie, and Ginnie, that never happens. They're not allowed to do that. So that's an interesting thing to say. OK, and I'll leave this. This is just a little more data on the HAMP report. Those are, if you're interested, I can take a question on this. So let me just conclude by saying, you know, it's been an unprecedented and sort of historic house price cycle. We've learned a lot, I think, over the last few years about how we got to where we are and how we went through this problem. We think that relaxed underwriting and investor interest played a big role in that cycle. Finally, for the first time ever, having done this presentation for a few years, I have some good news to report. It's been a long, hard road. But house price increases are reducing the number of negative equity households. But there still is quite a bit of a problem out there when it comes to negative equity. So a main important question going forward is, can we sustain what we saw last year and continue to see growth? OK, so I'll leave it there.